HMRC is tightening the rules for employee car ownership schemes from October 2026. It also remains crucial to classify vehicles correctly for tax. This blog post explains both changes and what to do next. Employee car ownership schemes are evolving, and HMRC's latest draft rules provide clear direction. From the 6th of October 2026, when a vehicle is transferred to an employee under a qualifying arrangement, a benefit charge may arise. These shifts mean employee car ownership schemes will need redesign, not just a tidy-up. If the vehicle's ownership is transferred to the employee, and any of the following apply: private use restrictions, the employee not being the registered keeper, or a set buyback onward sale, expect a benefit-in-kind charge to take effect from October 2026. This will give employers time to review contracts, funding models, and HR communications. Vehicle classification still matters, though, and the benefit charge is only half the story. Capital allowances and benefit-in-kind rules both hinge on whether a vehicle is classified as a car or not. In law, everything is a car, unless it is a motorbike, is primarily constructed to carry goods or burden, or is a type not commonly used and unsuitable for private use. Construction trumps usage. How the vehicle is built matters more than how it is used on a day-to-day basis. For combi and crew vans, the second row of seats often means the passenger area competes with the load space. Unless the cargo area clearly dominates, they're likely to be treated as cars. HMRC guidance and case law have taken a similar view. A commercial spec Land Rover Defender, with no rear seats or fixings and no rear side windows, can look much more like a goods vehicle and may qualify as such. We've discussed double cab pickups before. A large minibus may qualify as not commonly used and would be unsuitable for private use as license restrictions may apply. Convert it into a camper van, though, and those restrictions typically vanish, so it reverts to a car. For employers using employee car ownership schemes to move vehicles off the balance sheet or to share costs with staff, the interaction with classification is pivotal. A vehicle classed as a car can materially change BIK and allowances, whereas a qualifying goods vehicle can reduce the overall tax friction. Get the spec sheets and build data. Don't rely on marketing labels. What you need to do before the 6th of October 2026. Audit current contracts for private use restrictions, registered keeper status, and any buyback clauses. Remodel the total cost of reward in pound sterling for vehicles likely to be classed as cars, including Class 1A NIC. Update handbooks and user agreements, and align payroll and P11D processes. Engage dealers and converters early to lock in specifications that support the intended tax outcome. Keep supporting evidence, such as build sheets, seat configurations, bulkhead details, payload and load space dimensions, and any license requirements. Reference HMRC manuals and relevant case outcomes in your rationale. Clear records will support your position if challenged and will make renewals of employee car ownership schemes more predictable. Before launching or renewing employee car ownership schemes in the next cycle, mat each model against the construction test, then layer on the new qualifying arrangement rules. With thoughtful design and documentation, organizations can offer competitive packages while managing future benefit charges. When implemented effectively, employee car ownership schemes can still be highly effective, though they will soon need more thoughtful execution. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about employee car ownership schemes and how they'll need more thoughtful execution in future, then do call me on 01908 774320 and let's see how I can help you. Don't forget to stay updated with our daily social media posts on Facebook.